Here is your step-by-step guide on the discussion in week 3, adjust the financial balance. During this week, we compared what a film would actually look like in regards to its profits if we do a few things, such as comparing the film if it would be paid for by one investor, 100% equity. So if the entire budget of $5 million would be paid by one person as an equity investment, what would that look like in regards to the profits for this film? And then we're going to compare this if we take the same film, the same budget, but now we're going to change the way the film is financed. We're not going to have an equity investor provide 100% equity to cover the entire budget, but we're going to use some of the financial sources we have learned about to piece the finance plan together. And then we're going to look at what, if anything, changes in regards to the profits of this film. So here we see the funding schedule, the finance plan for a $5 million movie. And we are going to assume that the film will generate distribution revenues from the US of 35% of the budget. That's our projection. We're basically just projecting we can make 35% of the budget with a film from the US, and we are projecting that we can make 75% of the budget with a film from international distribution rights. So all we're doing here is we're following projections, meaning estimates that say this is what our film is worth in the worst case scenario. Worst case scenario being we're thinking if we're selling the film internationally through all the territories outside of the US, we can make $3,750,000 on a $5 million movie. And then we're selling the film also in the US. And if we do that, we can make $1,750,000. So we believe worst case scenario, if we're doing our $5 million film, we can make $5.5 million. So we're covering the investment. There's a little bit extra. So this is our worst case scenario projection for the film. So now we have someone giving us $5 million. And let's see what happens. And let's see if this person and us as the producer actually make any money. So when we look at the fact that, yes, we are actually then producing the film for $5 million and we're actually selling it for the amount that we have projected, we're actually going to get 35% of the budget from the US for distribution rights we sold in the US so that a US distributor can show the movie in US theaters, on US streaming platforms, in US television network stations, and so forth. And for this license, we received 35% of the budget, $1,750,000. So at this point, we are saying we actually made this money. We were right with our projections, and the US paid us $1,750,000 for the distribution rights to show the movie in the US. And internationally, we are also hitting our projections, and we're saying that 75% of the budget was covered through all the various sales we did internationally by selling the international distribution rights to international buyers such as network stations, theatrical distributors, and streamers. And altogether, we got 75% of the budget that were generated from distribution rights revenue sales, which is $3,750,000. So we are assuming in this case we actually were right with our projections, and we generated $5.5 million in worldwide distribution revenues for the film. But now we have to pay some people because there are people involved in getting the movie made and getting revenues generated. First of all, there is a collection agent, and that is a neutral escrow agent, if you will, who is put in place to make sure that all the distributors pay into one account that the collection agent manages, and then the collection agent will then take the money that comes into that account from the distributors, which is what they're paying. They're paying for distribution fees, and the collection agent will hold the money, and then that money will be used to pay for expenses, right? And another expense that we have is the expense that we pay the sales agent. The sales agent is the person who takes on our movie and then sells it to the US distributor and to all the buyers internationally. The sales agent doesn't do this for free. They're charging us a sales fee. So in this case, the sales agent charges us 16% of whatever sales that they have generated, and 16% of 5.5 million, which is the distribution revenues they have generated, is 880,000. The collection agent usually receives 1% of all the monies that hit the collection account. And because we received 5.5 million, the collection agent got $55,000 and the sales agent gets $880,000 as a sales fee. And because we don't have a bank loan here, we don't have to pay any banks back, but we have to pay the equity investor their $5 million back. So we're doing that. So altogether, having paid the equity investor $5 million, having paid the sales agent their sales fee, and having paid the collection agent the collection fee, we are spending $5,935,000 on a film for which we have generated 5.5 million. So clearly, we are already in the loss category because we don't have enough money to pay for these expenses. So right now we're showing a loss of $435,000. We couldn't even pay the equity investor back in full. We couldn't pay their premium. So right now the premium has not been paid. The equity investor is $435,000 in the red. Now, what would happen if we would take the same movie that is $5 million and it obviously would then also generate the same revenues from distribution rights, which was $5.5 million, which is what we're projecting right now, again, as we put this movie together from scratch. But this time, we're using the finance sources we have learned about, which is a bank loan for pre-sales and for unsold rights. And we're looking at a production incentive because we're shooting in a region where we're going to get an incentive. And then we're going to finance the rest with equity. So it starts out with, we're assuming that of the international distribution revenues that are estimated to be $3,750,000, we're actually going ahead and doing some pre-sales. These are distribution agreements that are generated before the film is produced, based on the film's script, the cast, the director, and the budget. Based on those elements, distributors pre-buy distribution licenses, and we then take those license agreements to a bank who will give us a loan for these license agreements. And when these distributors arrange and agree to pre-buy our film, they will have an installment in their contract. Installment payments that dictate a down payment that is due at the very time the distribution agreement is signed, and the balance is due when the film is delivered to the distributor. So in this case, 20% of the distribution license fee is being paid by the distributor at the very moment they sign the agreement. So that is 20% of $1,750,000, which is $350,000. That money sits with the sales agent and is waiting for us to be used for the production budget and for the covering of the cost at the time we have put all the other finance elements in place, which is when we get this. So this is actually the first money that we have raised now based on the pre-sales. So then we're taking these pre-sales to the bank. The bank will deduct the down payment that we already received from the distributors and will give us a loan of $1,400,000, which is the pre-sale loan for the pre-sale agreements of $1,750,000 minus the down payment received from the distributor of $350,000. So that is $1.4 million we are now receiving from the bank as a loan for these pre-sale agreements. But the bank will do something else. They don't just give us a loan for the pre-sale agreements. They will also give us a loan for the distribution rights they believe we can still sell. So what are those? If we have international distribution revenues estimated to be $3,750,000, and these are all the international rights that we can sell, and of those rights, we make pre-sales of $1,750,000. We are left with $2 million that we can still sell in distribution rights internationally. And the bank will look at the $2 million and say, okay, we will give you a loan against this as well. We'll only give you 50% of the $2 million, but we'll give you a loan for it. So they give us $1 million based on the fact that we have $2 million worth of rights that we can still sell, which are also referred to as unsold rights. So if we're adding the $1 million gap loan to the $1.4 million pre-sale loan, we're ending up with a senior loan altogether of $2.4 million. So now we have two items of financing that we already received. We received the pre-sale down payment of $350,000 from the distributors, and we received the bank loan of $2.4 million. So now we are shooting in a production incentive that gives us 20% of our budget, and 20% of $5 million is $1 million. So here we want to get a loan for this incentive. So normally you would go into the production incentive region, let's say New Mexico, you would shoot your movie there, you would spend the money there, and then at the end of the shoot, you will bring all your receipts to the New Mexico authorities for this incentive, and then they will give you money back in regards to the rebate that they give you based on the receipts you show them. But there is a way to do this where you estimate in the beginning what expenses you will have in the region, what will be spent in the region, and then what, as a result, you would get as an incentive from the region. And this estimate you can take to a lender, and that lender will actually give you a loan based on this estimate. So now you can use this incentive as a portion to cover your production budget because you're getting a loan in advance. And this lender will then be repaid by the incentive region, who will give them the money instead of us based on the movie being shot in this incentive region and based on the rebate being due to the producer. So in this case, the producer is not getting the money from the incentive lender is getting the money. So to us as the producer, it means we're getting the incentive early on. We can use it to cover our budget, and it is a non-recoupable item to us, meaning we don't have to pay this back, because the incentive region is paying this lender back instead of us. So if we're adding the $1 million to the $2.4 million bank loan and to the $350,000 that we received from the distributors, we end up with funding of $3,750,000. So what is left to hit our budget of $5 million is $1,250,000, which we will cover with equity. So instead of getting a $5 million equity check, we're now getting a $1,250,000 equity check, which is not 100%, but 25% of the budget. And now the question is, will that change the profitability of this movie? And the answer is yes, it will, because here's what's happening. We are again generating $5.5 million from worldwide distribution as we have projected. We are deducting, of course, the $350,000 that we already received from the distributor. So we're left with $5,150,000 that we still would be getting from the distributors at this point. So the collection agent again charges 1% because they're managing all the revenues that come in and all the expenses that have to be paid and all the payments that have to be made. That's the job of the collection agent. And for this work, they charge 1% of whatever amount hits the collection account, which in this case is $5,150,000. So 1% of that is $51,500. And again, the sales agent charges their expenses and distribution fees, which again is $880,000 as it was before. But now we have some other things that we have to pay back. We have to pay back the bank loan that we received, which was $2.4 million. And of course, we have to pay back the equity of $1,250,000. And we have to pay the premium that is due on the equity of 20%. That is 20% of $1,250,000, which is $250,000. So all in all, if we look at the collection agent, the sales agent, the bank loan, and the equity and the premium, our expenses are $4,831,500. So now we turned the loss into a profit of $318,500. So when we look at our entire finance plan for this case study 3 for our discussion post, you see here the increased budget of $7.5 million. And this increased budget obviously follows through when we are looking at the project valuation, because here we see that the international distribution rights revenues of 75% of 7.5 million now are 5,625,000. So they're higher than they were with our original movie at $5 million. In this case study, we decided that we believe we can sell the US distribution rights for 30% of the budget. So we're putting this assumption in here for the valuation. 30% of $7.5 million is $2,250,000. So our total valuation, as we are projecting it to take place for this $7.5 million budget, is to show us a minimum worst case scenario gross revenue from distribution rights sales of $7,875,000. So when we look at our finance plan, the first thing we're going to do is start doing our pre-sales. Again, these are distribution agreements that are made before the film is produced. They're regular distribution agreements. They do not look any different than any other distribution agreement you would do. The only difference is they are made before the film is produced versus the regular distribution sales or distribution agreements, also called sales, are done after the film is produced. So here we are accomplishing 35% of the budget in international pre-sales, in distribution rights agreements we enter into before the film is produced, and 35% of the budget of $7.5 million is $2,625,000. When these distributors do a deal with us, a pre-sale distribution deal based on them reading the script, considering the cast attachment and the director as well as the budget, they are doing the deal in a form that allows them to pay in 2 installments. And the first installment is usually anywhere up to 20%. The second installment is then due when the film is delivered. So that's anywhere up to 80%. For us, this means that we're not actually seeing the 80% of our pre-sales until the film is finished, unless we take our distribution agreements that we have concluded as pre-sale deals to a bank who would cash flow these agreements in advance. And they would take the distribution agreements themselves as security and then would have the distributor pay back the bank directly, which happens either through the collection account that we are putting together with our neutral escrow agent, or the bank requires that all the payment in connection with the pre-sale deals are done directly to an account that our senior lending bank would establish. So long story short, we are taking our pre-sale deals to a bank and they're giving us a loan. Now in this situation, not like before where the bank gave us a loan of 100% of all the pre-sales, they are discounting the value to 85%. So what happens here is that of the $2,625,000 pre-sale deals that we have concluded, the bank will cash flow 85%, which comes to $2,231,250. So all they do is they look at the distribution deals that we have made and decide there are maybe a few buyers here that they're not, that they might not know, or maybe their track record in paying on time is a little spotty, or maybe they come from an economically challenged country. Obviously, this changes country to country often, but right now the bank will look at these agreements and say, you know, there are some of the distributors here that we're not all crazy about, so we're going to apply a discounted rate for these deals. And so altogether, we're seeing an 85% cash flow amount of $2,231,250. So then the bank also knows that these buyers have given us already a down payment for these deals, and therefore deducts that down payment because we already received this money. So if the bank would give us a loan of the entire amount, they basically would pay us twice. We would get the money twice. So since we already received the down payment of $525,000, which is 20% of the international pre-sales of $2,625,000, we received it already, which means the bank they will deduct it. So The subtotal that we then have available would be 1,706,250. So that's the pre-sale loan amount that we are looking at net of the down payment. So let's look at the gap loan. In this scenario here, the assumptions provided a percentage of 15%. So 15% of the budget is supposed to be the gap loan. So that is 15% of $7.5 million, which is $1,125,000. So altogether, our senior loan is now $2,831,250, and that's the portion that we can also use to get our budget covered. So the first amount we received was the pre-sale down payment of $525,000, and the second amount we're receiving now is $2,831,250. Now the production incentive, which is the incentive that is given to us based on us producing the film in an incentivized region where they basically give you money for all the money you spend in that region. So the incentive region has determined that our budget of $7.5 million would receive a 25% incentive. So that assumption paper is basically handed over to a lender who would then give us a loan in advance of us producing the film in the production incentivized region. Normally what would happen is that you would produce the film in the region, you would show the incentive lender authorities all the costs that you have, and they will then issue you basically the check for the incentive, which could be a rebate, a credit, or a grant, or a combination. Now this would happen after the film is shot. In order for us to use this incentive in advance and use the amount to actually cover a portion of our budget, we will take this incentive assumption that was established to a lender who will then give us a cash flowing amount of this incentive. So they lend against the assumption that was provided to them. So they're giving us here $1,875,000 as a loan. So altogether, the incentive, the senior loan, and the down payment, we have now covered $5,231,250. We have to, however, cover $7.5 million. That means our equity investor has to give us $2,268,750, which is 30.3% of our budget. So let's take a look at what our recoupment schedule would look like with this reduced equity scenario C. The budget was $7.5 million in this scenario. So we're looking at what actually happens after the film is finished. So in our scenario, we are assuming, and we're seeing now that our assumption of selling 30% of the US distribution rights has come to fruition. We actually do sell the film and did sell the film for 30% of $7.5 million. So we received $2.25 million in revenues from distribution rights. So the US buyer, which could be a theatrical distributor or a network or a streamer, would pay us $2,250,000 to release the film in the US. The international distribution rights revenues from all the international buyers outside of the US also has come into fruition, as we have established in our worst case scenario at 75% of the budget. And we indeed sold all the rights to international buyers and received $5,625,000. So altogether, we have received the $7,875,000 that we have projected. We have to now deduct again the down payment because we already received this amount. That leaves us with revenues of $7,350,000. So now we are looking at expenses, and here we are seeing the first expense going to the collection agent. This is the neutral agent. It's basically comparable to an escrow account, if you will, where all the distribution rights revenues are paid into. So this collection agent manages all revenues and manages all expenses. So all the money goes into this collection account, and for the work of managing the revenues and expenses, the collection agent charges us a fee of 1% of all the monies that hit the collection account. Because we received $7,350,000 in our collection account, 1% of that charged by the collection agent would therefore be $73,500. Next in line is our sales agent, and they're charging us a sales agency fee of 15% plus a distribution expense of 1%, totaling $16 million. So in our case, we are saying that the sales agent is getting 16% on all the rights he has sold, which in this case included the US rights. So you will have many cases where the international sales agent is actually only selling international distribution rights and not the US, and we'll talk about that as we go later into our modules. But here in this scenario, we are assuming that a sales agent sold all the international rights but also the US rights. And sometimes this happens when a sales agent has good relationships with US buyers as well as international buyers. So in our case, we chose a sales agent who does have these relationships with US buyers and international buyers, and therefore was able to sell both US distribution rights and international distribution rights. And for the work of doing so, they're charging us 16%, which would be 16% of $7,875,000, and therefore is $1,260,000. The bank loan is now having to be paid back. Bank loan also referred to as the senior loan, and we had a loan of $2,831,250. So that means we are now paying the bank loan back here. $2,831,250,000 are now paid to the bank. Now some banks will decide to want to be paid in first position outside of the collection account, which would mean that the ranking would jump them up in first position. So you will see in the reality out there, sometimes depending on what bank you work with or what senior lender you work with, that they would want to be recouping in first position. That means they have their own collection account set up, their own receivables account, and that bank loan would then not go to the collection agent. Actually, the distributors would pay the bank directly through an account that the bank has set up for that purpose. So in that case, the senior loan would be recouping in first position instead of the collection agent. But very often you will find what's happening here. Collection agent gets paid first, sales agent gets paid second, and then the senior loan is paid. Last in line of all the repayments we have to make when it comes to finance sources for a film would be the equity investment. Here, the equity principal investment amount of $2,268,750 is now paid, and we're now adding the premium that we're owing to the equity investor, which is 20% on his money. That would be 20% on $2,268,750 and would therefore be $453,750. So altogether, if we're adding up the premium, the equity investment, the senior loan, the sales agency fees, and the collection agent, we have net revenues of $462,750 after adding all the expenses and deducting them from the gross revenues. So now we have a net revenue of $462,750 that we can now share when we do our back-end participation payments. And here, everyone gets paid at the same time. So there's no ranking order in the profit participation. Everyone gets the percentage that they're contractually agreed to receive. In our case, we only have the equity investor that we need to share with. The equity investor, as you remember, gave us 30.3%, which is summed up here at 15.1. If I would make this two numbers behind, the percentage would probably be 15.15, but in this case Excel rounded it, so it's 15.1%, which is fine. 69,991 is going to the equity investor, which leaves us with 392,759. So the way we are calculating the profit participation is we're calculating the percentages in relation to the net revenues. So because we have 462,750 left of that, the equity investor gets 15.1% and we receive the rest. Now, if we look at what the equity investor actually earned on this film, we would look at first the premium, which is 453,750, and then we're adding the profit participation payment of 69,991. So altogether, the equity investor now made 523,741,000 on their investment amount of $2,268,750. And as always, if you have any questions about the case study presentation here, please email me through Canva's inbox and I'll be happy to answer your questions. And of course, you can always email me to set up a one-on-one session and we do this case study together.